Hi there. I had a client this weekend that asked me a question, and I've always believed that whenever you get one question asked, that multiple people want to know the answer to it. And so they said, "Hey Yvonne, I got approved for a loan amount, but I don't know what that means. What does that mean in regards to," they talked about escrow, they talked about MI, they talked about the loan amount, they talked about what I needed to bring to closing, but all of it was so new to me, I didn't quite understand. Well, let's go back, and not to insult anyone's intelligence, but I believe in taking things step by step. That way, if I cover something you know, great. But if I cover something you don't know, even better. So let's go back to the beginning. When you get ready to purchase a home, the very first thing that the agent is going to ask you is, have you been pre-qualified? What that means is, have you had a lender, somebody that's going to give you the amount of money that you need to purchase that home? Have you gone to that lender and that lender look over your finances, look over your W-2s, look over your credit report, look over how many bills you have, how much outstanding credit you have, and look at your credit scores? That's what a lender will do. So when they say, have you been pre-approved, they're asking you, hey, have you gone to a lender and asked them to look over your finances to see if you qualify for a house? And then also not only if you qualify, but how much house can your current budget afford without you going under, okay? So, and let me say this to you. There are different types of lenders that we go to. You can go to a mortgage broker, you can go to a mortgage banker, or you can go to a bank like a Wells Fargo, a Chase, or you can go to a credit union. The typical lenders that you would probably know about would be a bank, a Chase, a Wells Fargo, that kind of institution, or a credit union, Navy Federal Credit Union, Teachers Credit Union, any of the credit union places. But I want to talk to you about the mortgage broker and mortgage banker and what's the difference. When you go to a mortgage broker, you are saying to them, in effect, just like you would to a car dealership, I want a house. I want you to find me the best rate available. Rate meaning interest rate. I want you to find me the best rate available. So what that mortgage broker does is he then begins to shop. What that means is he goes from lender to lender to lender to lender and shops your credit for a lender to say, okay, I'll take this person, or multiple lenders to say, okay, I'll take this person. But sometimes, and this is what you need to be aware of, and this is what you need to ask, when a mortgage broker shops your credit can tend to go down, 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 just like if you shop with a car dealership, that credit goes down. But mortgage brokers know how many times to shop that credit to keep it from going down. So I'm not saying that every time a broker shops your credit scores go down, but this is a question that you need to ask. Will my credit score go down each time you shop it? And how many times? How many bankers are you taking my application to? Now, the next is a mortgage banker. What's the difference in a mortgage banker and just a regular bank? Well, a regular bank like Chase, Wells Fargo, and any of those other big commercial banks, they not only do mortgage loans, but they do checking, they do savings, they do car loans, they do all types of things. They have a big basket. Whereas a mortgage banker, their primary thing is loans, home loans, refinancing, anything to do with purchasing your home. They don't shop it out. It's usually an in-house thing. Now, speaking of shopping out, let me say this to you. Once you close on your property, the odds are that whatever company financed that loan, gave you the money for that loan, that company is going to, it goes into this big mortgage pot, for lack of a better term, and then they sell it to different investors. So that's why when you close on your home, you may be paying your loan to Wells Fargo, Leader One Financial. You may be paying it to to a particular bank, but after it closes, they being that company, they take that loan and they put it in this big pot where now the investors pillage through the pot to say, I'll take that one, I'll take that one, I'll take that one. And then that you get this letter saying, your loan has been sold to XYZ mortgage company. So in the future, pay future payments to XYZ. Nothing wrong with that. That's just the way of the mortgage world. So back to you saying, I want to understand what's going on with my mortgage. So now we've talked about how they shop it out, how they get the approval. Now, they will tell you, you have to pay 3% down, 20% down, 5% down, just depending on the type of loan that you get. FHA is usually, remember, in mortgages and in real estate, there is no locked concrete rule for fees and charges and rates. So they may say you may need to put 3% down, 5% down, 20% down. Typically, and hear me use the word typically a FHA loan, you will come to the table with 3% plus your closing costs. And we'll talk about closing costs in a minute. With conventional, you may have to come with 5%. If it's a investment property or not your primary dwelling, that means you're not going to live there. Like it could be a vacation home, it could be an investment home. Typically, you'll be asked to come with 20%. And then for those men and women in our armed forces, VA will usually say 0 down payment, okay? So like I said, no hard and fast rules, but that's just the general overall. So when they tell you what you need to come, they'll say, based on the amount of money that you make, based on your income, taking away your debts and leaving room for food and different things, they'll say that your LTV, your loan to value, meaning this is how much money I'm going to lend you based on what you have and the value of the home that we are going to tell you that you can afford. So when they give you that, and they may say you qualify for, I don't know, $300,000 house, okay? They'll show you $300,000 is the sales price. Then right before that, and all of this information goes on a worksheet. Now the agent, me or any other agent, the agent gets the pre-approval letter. Pre-approval letter does not give your specifics. The pre-approval letter says basically you can get a house for $300,000. We don't know, and we don't really even care to know what your finances are. That's between, my grandmother used to say, that's between you and God. That's between you and your lender, what your financial makeup is to give you the value that they've given. So they'll send to the realtor a letter that says, John Doe has been pre-approved to purchase a $300,000 house. Now we start looking in that range based on what John Doe has said he wants, okay? We tell John Doe, listen, if you see something that exceeds that $300,000, that means that you're going to have to input that difference, because all the lender is going to give you is based on you finding a house for $300,000. Now, in the same breath, after the lender has given you all the calculations of what your monthly payment will be, if you say, hey, I don't want a house that costs $300,000, at that point, it's up to you to make that decision on how much mortgage you want to pay. And you'll go back to your lender and say, hey, I don't want to go over this amount. Say, I don't want to pay more than $2,500 in mortgage. Then the lender will say, based upon that, and remember, until you find a house, everything is a guesstimate. So they'll say, based upon that, don't look at a house that exceeds, and then they'll give you that amount. So they'll tell you how much house you can get. Then they'll tell you how much money they are going to give you for that particular house. So they say you can get a $300,000 house, and they say you've got to come to the table with 5%. So that means that you've got to come to the table with $15,000 on a $300,000 house, and that they are going to, they being the mortgage company, they are going to give you $285,000. What they give you and what you bring to closing should equal the sales price. Again, what they give you and what you have to bring to closing equals the sales price. So if you stick to that $300,000, the lender is saying, you bring 5%, we'll give you 95%. You bring $15,000, we'll give you $285,000. The two will make the $300,000, and there you have it. Now, in that mortgage payment structure, let's start from the beginning. In that mortgage payment structure, you are paying on a loan of $285,000, okay? You're paying that based on the interest rate, based on 30 years of financing, where the majority of it is interest, but you're paying on that $285,000 based on the interest rate. That's the principal, okay? Now, added to that mortgage payment or to the principal is interest, okay? I take that back. Added to that mortgage payment, the principal and interest is the one thing, and then the next thing is the taxes. Now, depending on what area of the city, because Houston is so big, and I'm a licensed agent for Texas, and I'm talking about my area, which is Houston. Depending on that area is going to determine what your taxes are. Now, a lot of your taxes is rolled into the school taxes. The areas in the suburbs that have the highest ranking schools tend to have the highest taxes. So when a family comes and they say, I want Cypress because of the school district, or I want Katy, or I want Tomball, they're saying, I want this area because of the school district. But keep in mind, sometimes the tax rate, most of the time, the tax rate in those areas is expensive, and the bulk of those taxes is rolled into the school taxes, okay? So now you're paying the principal and the interest on $285,000. Then you're paying your taxes. If you're strategic, you purchase your home where at the beginning of the year, you're able to claim what's called a homestead exemption. In that homestead exemption, you're able to get a tax reduction because you live in that house. That's not an investment property, that's not a vacation rental. It is your primary investment, your primary dwelling place, okay? So therefore, you're able to claim an exemption called homestead exemption. The tax districts also give you a break on those school taxes, especially if you are over the age of 65. You get that exemption. Then you can get an exemption if you are considered disabled, okay? I won't go into that disability exemption. If you feel like you may qualify for that, you will get on the phone and call Harris County Appraisal District or Montgomery County Appraisal District or Fort Bend County Appraisal District. Whatever district that the house you want to purchase is in, you can call them and ask them if you qualify. Another great benefit for the men and women who have so faithfully served our country and are considered 100% disabled, they will pay no taxes. They will pay no taxes on the home that they purchase. And I laugh and I tell my veterans, wow, you're lucky. But you know what? Those men and women have paid a price not to have to pay taxes. So I honor you. I thank you for your service, and you deserve just that small little perk. So now we've got our principal, our interest, our taxes, and the next thing that's going to be included is insurance. Unless you pay that house off in full, you're going to have to pay insurance or buy insurance. Just like with a car, you've got to purchase insurance that covers that dwelling if something happens to it. And also, and I won't get into it in this video, is talking about what you're paying insurance on if you buy a condo as opposed to buying a single family dwelling, okay? But you will pay insurance. Where does that price come from? It's not just pulled out the air. It comes from the insurance company that either the mortgage company gets for you or the insurance company that you choose to use. A lot of my clients just go to the insurance company that they have their car insurance with, or their boat insurance, or their motorcycle insurance. They'll go to that company so that they can get what's called a bundle. And it's bundled together, and they don't make that payment directly to the insurance company. They have to pay what's called escrow. So often I get the question, what is escrow? Escrow is a total payment of the principal and the interest, the taxes, and the insurance bundled together and paid to the mortgage company. So whenever you have to escrow your mortgage loan, all that's saying is, hey, I'm going to give the mortgage company all of the money, and then when it comes tax time, they can pay my school taxes, they can pay my municipal utility district taxes, they can pay any taxes that are due, they will pay those taxes. Usually at closing, that means when we get ready to sign on the dotted line, or when you do anyway, get ready to sign on the dotted line, at closing, you will have what's called a settlement statement. And on that settlement statement, you'll see where at least 15 months of insurance is collected. That means that the lender is getting a year in advance of insurance plus 3 months, okay? And that's just so that your account is not depleted once they pay out everything. And usually they will collect, they being the mortgage company, will collect at least 3 to 6 months of taxes in advance. These things are called prepaids. With these prepaids, meaning I've prepaid a year and 3 months of insurance, I've prepaid 3 to 6 months of taxes, and that all goes in my personal pot to the insurance company. Not to the insurance company, to the mortgage lender, so that when it comes time to pay in November, December, when it comes time to pay my taxes, they'll pull out that money and they'll send it off. And then my account still has some funds in it so that it can roll over, and they'll start deducting. Now, in another video, I'm going to talk to you about, remember how I told you the majority of your loan amount is interest? We're going to talk to you about, or I will talk to you about how to reduce that interest by tens of thousands of dollars just by making one extra payment per year. And you can do that where you don't even notice that you're making that one extra payment. But we'll talk about that amortization at another time. So when you get ready to purchase your home, remember, not only that 5%, remember the $15,000, not only that 5% will you have to come to closing with, but you're going to need some extra money. What do you need that extra money for? You need that extra money for that insurance. Remember, 15 months. You're going to need that extra money for your taxes. Remember, they're going to collect 3 to 6 months of taxes. So it's not all closing costs, but it's prepaids as well that you will have to pay. Depending on how your contract was negotiated, the seller may contribute some money towards your closing costs, but at the end of the day, this is money that you need to have in your mind that you're going to need. So you're not just going to need that 5%. You're going to need money for your taxes, money for your insurance. They're going to collect all of that. And then the lender will say, this is a guesstimate. That means depending on, they may calculate taxes for general Houston area, but when you actually find a property, they can hone in and tell you exactly what tax rate you're going to be paying for your particular property. So when you get ready to come to closing, that lender has already given you a guesstimate of what you need to bring to the closing table. And usually it's really, really close. So keep that in mind. It's not just the 5% that you need to use to cover the loan amount. I hope that this video has been of some help. Please follow me, because we're going to talk about how you can cut 8 to 10 years off of a typical mortgage by actually doing nothing that's outside of your normal payment plan. We're going to talk about what it means for the different tax districts and the difference in amounts. I love having an educated client because the more you know, the better the decision you can make when we get together and start looking for your home. Balanced Life Realty, we're a small company, but we care for our clients, and we hear you and do our best to answer your questions. Thank you so much, and until next time, have a good day.